When you start dividend investing, or even before you start, it can seem like it's very complicated and that there's a huge amount in it. But the reality of it is you don't need to be an expert to do it. And in this video, I've put together all of the kind of basic information I've picked up over the last 3 years of doing it, and it should help you to get the ball rolling yourself. So although I'm certainly no expert in it, this video is more like the safety rails in a bowling alley. They're not going to make you an exceptional bowler, but they will help you avoid disaster. And I'll use examples from my own portfolio to run you through exactly how it works. It will give you a good foundation of where to start. So by the end of this video, you should have a pretty general understanding of what the stock market actually is. You can get started making your own goals and strategy in your own dividend portfolio. I'm going to assume that you are looking for dividend stocks, as this is the Daily Dividends channel. But if you're looking for stocks that don't pay dividends, or if you're looking to trade, this video should help to clarify things from the beginning for you. Then as we get further into the video, I'll run through the basics of how to decide what to invest in. So how often you want to invest into any company or ETF or a fund, also how much money, choosing a broker that suits you, and the kind of portfolio that you have. Now you could have one stock or one fund or 3 funds, or depending on what suits you. I'll also give you the general rules of how to value or how to pick a dividend stock. And as I said, I'm no expert, so it'll be more like the general toolbox that these specific tools that you'll learn later will then fit into. I'll run through some of the most common abbreviations and definitions that you'll see from the start, and I'll also give you a few tips on what has happened to some of my positions and what could happen to yours.
Anything else? You're boring the whole of me.
So a couple of very important things from the very beginning. If I say share or stock or position, they all mean the same thing. If you put €100 into Coca-Cola and it buys you 2 shares, you have 2 Coca-Cola stocks, or you have 2 shares of Coca-Cola, or you have a €100 position in Coca-Cola. And the second most important thing is when you open an invest account, this is the broker that I use, Trading 212, you cannot lose more money than you put in to an investment account. But if you open up a CFD account, which are contracts for difference, that's where it starts to get dangerous. You're basically signing a contract to say you're going to buy a certain stock at a certain price, and the leverage is a multiplier. So you could pick something and it could multiply by 10 very quickly, which an investing account is not going to do. It's not 2021 anymore. But the same works the other way. If it goes the wrong way, you can lose 10 times what you put in, and your broker can automatically sell that for you because they don't believe you have the money to allow things to get worse. So if you want to play it safe, stick to the invest account. And if you want the straight gambling, that's options or CFD accounts, contracts for difference. So what is actually happening when you buy stock in a company or an ETF or a fund? All of which are known as financial instruments. Any company or fund that's publicly traded quite simply means the public has an opportunity to buy in, and then a privately owned company or fund is just that, it's private. So if you were a multi-millionaire or multi-billionaire, you could buy 10% of a company quite simply by buying 10% of the available shares. And the reason companies or funds do this is, if we take this company as an example, Berkshire Hathaway, this is the company run by Warren Buffett and Charlie Munger. Because of their expertise and their knowledge in investing, it will cost you a cool $500,000 to buy 1 share in their company. And because it is publicly traded, there is obviously a lot more money in the public than there is in private investing. Warren Buffett and Charlie Munger don't have to spend all day calling people trying to get them to invest in Berkshire Hathaway. The amount of shares that are available are called the shares outstanding. That's the total number of shares issued and actively held by stockholders. There is also insider shares, but those are held by people inside the company to stop anyone coming along and buying 51% of the company and running it into the ground because they don't know what they're doing. Now it is up to the management of the company how many shares are available, and that amount can change at any time, but I'll get into that later in the section on what can happen to your positions. So now we'll get rolling on how to get started. And the most important thing from the very beginning, before you ever even consider investing any money, is set up an emergency fund. Now, no, you've probably heard this many times before, but it is very important. And the point of it is, if you make, say, €400 per week, working 40 hours, you have no savings, you have no investments, you're one accident or one stroke of bad luck away from being in big trouble. If you manage to put €10 out of that €400 per week away, that's a start. If the car breaks down, or you have a medical emergency, or your phone breaks and you need it for work, you have to replace it. You have to pay the medical bill, you have to get the car fixed, you have to get the phone fixed. And if you have nothing put aside, but you do have money invested, you're going to have to sell what you have invested. And you could end up like this. This is one of my positions, Gold Resource. I bought 79 shares of this company. My average price is $1.63, and they're now worth 27 cents per share. So I am 82% down. Now, I put in about €110, and the strategy I use with this portfolio is to have maximum 1,000 positions that all pay dividends, and I want to have very frequent but quite small dividend payments all year. And one of the plus sides of this strategy is when a stock goes down 82%, and this is dead, like I don't see this ever coming back, I'll be down €110. But if this was the stock that I picked, the only stock for my portfolio, and this happened, I'd give up. I would be done. And if I'd put all of my savings in here and I had no emergency fund put aside and something happened, I could have to sell these for an 82% loss. And while I'm on the topic, there is an important thing to point out. You can harvest tax losses. So if you put loads of money into a company and sell it for a loss, you can carry those losses forward forever. So when you have to pay tax on stocks, which is called a capital gain, that's when you take anything and sell it for a profit, you have to pay tax on it. You can carry those losses forward to lessen the taxes you pay in the future. That's the only real plus side. But if this was an emergency, I would be in deep trouble. Ideally, you should have your emergency fund in a place where you don't have immediate access to it. As in, if you use Revolut, having it in a vault and having access to it when you're on a night out or at a moment of weakness is not ideal, but somewhere like the credit union or the post office would be ideal. And how much to have in your emergency fund?
What are we talking, Matt, in thousands? Tens of thousands?
£500 or £600.
£500 or £600. 30 pieces of silver.
Again, it's up to you, but a general rule of thumb is 6 months of expenses. So if you lost your job tomorrow, you could survive for 6 months purely on the emergency fund. Now, the next thing you have to do is clarify what your goals are. And the easiest way to do this is to ask yourself, how old are you and how much risk can you take? There is a huge difference between an 18-year-old investing and an 80-year-old investing. If you've worked your entire life and you've kept all of that money and you have absolutely no idea how investing works, and somebody who claims to know tells you you should put all of it into this company and then the company goes bankrupt, you're in massive trouble. But the younger you are and the earlier you start, the more risk you can afford to take. Now, I don't mean buy random companies to see what happens, but if you see a company that yields 50% dividend yield or 100% dividend yield, it can be very enticing. I've fallen for them before, like this one here, Zim Integrated Shipping Services. I'm now 72% down. Or this one here, Armour Residential Real Estate Investment Trust. This pays a dividend every month. I'm about 63% down now, and according to this, the dividend yield is nearly 30%. So if I put 100 grand into this stock, it would apparently pay me 30 grand a year.
Oh, that's the funniest I've ever seen.
Yeah, they're not going to do that. A company can stop paying a dividend whenever they want. They can cut the dividend whenever they want. It is entirely up to them. Dividend yield is not a great indicator of future returns. The only thing you really have to keep in mind with the dividend yield is the area between 3% and 5% is considered the sweet spot, the safe zone. Anything above 5 is a little bit risky. Anything below 3 is not really worth it, because inflation in most places is targeted to be about 2%, so if you're receiving less than 2%, you're not really receiving anything. So depending on your age and your circumstances, or quite simply how much risk you can take, the next thing you should get into your head is how long you want to be invested for. Are you saving for retirement? Are you planning on putting a large sum into a company and selling it next week because you think it's going to go up in the next few days? Or are you not really too sure? Obviously, things change. No, you don't have to marry yourself to any particular strategy. And to be honest, I think the best thing to do is both. You can have an account that you use to save for retirement. Maybe the stocks in it don't pay dividends so that you don't have to pay any tax on it until you sell them. Or you can have a trading account. And there is an important difference between trading and investing. They're not the same thing. Trading is buying with the intention of selling in the short term, hopefully for a profit. And investing is putting money away with a more long-term time frame. So if you're the type that doesn't want to spend any amount of time, apart from opening the account, pressing buy and then closing it again, you could buy something like this. This is an exchange traded fund of the S&P 500. And the S&P 500 or the Standard & Poor 500 is the top 500 stocks on the US stock market. And this company, Vanguard, basically does all the work for you, and the return that you get is what you would have gotten minus their fee. So once a company stops being in this top 500 list, It just gets replaced with the next best one. And the design behind these is slow but steady growth. Now, as you can see, when all of the companies or even some that have a huge weight in the S&P 500 drop, this fund can drop massively, but they are designed to go up over time. Or you can go for the more volatile ones like this if you do desire trading. Now, thankfully, the stock market only works between kind of regular daylight hours. Obviously, the times vary from country to country, but it's not open Saturday, Sunday. If you really like volatility and you want to sit up until 5 or 6 o'clock in the morning looking at graphs, I suggest cryptocurrency, as dangerous as it is.
Come away from the windows! Come away from the windows! The sun is up outside.
So the next mystery to solve is how much are you going to invest and how often? And this brings up the important difference between lump sum investing and averaging in, which is also called dollar cost averaging. Now, because whatever instrument that you invest into has its gain or loss measured as a percentage, if you were to invest a lump sum into something and it goes up, say 10%, then the entirety of your portfolio goes up 10%. So if you put 10 grand into a stock and it goes up 10%, you can sell it for 11 grand immediately. But the same applies the other way. If you invest into something and it drops, your entire portfolio drops. So if you are going to invest a lump sum, you really have to do your research. Warren Buffett has another great quote about a punch card. He said, if you had a punch card and every time you made an investment, you had to put a hole in it, and you could only have a total of 10 holes, every one of those decisions would be completely and thoroughly thought out, because the reward is potentially much higher, but so is the risk. I do prefer the idea of dollar cost averaging, and as the old saying goes, time in the market is better than trying to time the market. So if we take this stock, Diageo, as an example, you could have bought into Diageo for £40 a share on the 20th of December of 2021. And between then and now, it's dropped down to £28 per share. So if you have a short time frame in mind, like trading, trying to catch these at the bottom and then sell them at the top is very, very hard to do. But if you have a more long-term mindset, and you see a great stock like this, Diageo, go down, you can comfortably put more money in for cheaper than you had the first time. That's what averaging down is. So down here on this broker, you can see the average price. My average is £30.75 per share. I'm down about 10% in total. And if this was the only stock in my portfolio, I would be happy to put more in. But as time goes on and it grows and grows and grows, you will also have to buy when it's more expensive than the first time you bought in, which is averaging up. Of course, you will also want whatever you invest in to appreciate in value. But if you have a 10-year time frame in your head, these are just little discounts that pop up every so often. So overall, my recommendation would be to do both. If you have a lump sum, say you had 10 grand to invest, you could put a grand in this week, you could put a grand in 2 weeks, another grand in another 2 weeks, and you can also keep a considerable amount of your portfolio in cash to be able to scoop up these dips when they happen. Which brings me on to the next point, which is portfolio allocation. Now, the first thing to note here is the difference between concentrating your money and diversifying your money. And the general consensus about it is concentration builds wealth and diversification protects it. Now, if you already have a large amount of money, you don't have to worry too much about concentration, because if you have a portfolio that pays, say, between 5 and 8% per year, and you have €100,000 to invest, that's 5 to 8 grand a year, as long as you do your research and you make the right investing decisions. But diversification is a protection against ignorance. So if you're not too sure which single stock to pick, having a portfolio that has, say, 10 stocks in it, one is in the energy sector, one is a financial company, one is in home improvement like Home Depot, one is in food processing, one is in beverages, one is in alcoholic drinks, one of them is an airline. When a particular industry or sector suffers, you'll see that section of your portfolio drop. If you have good faith in the companies, that's just a discount to scoop up. Or if you were to buy something like an ETF, this one is called the FTSE 100. This is a fund that trades the top 100 stocks on the London Stock Exchange. You don't really have to worry about economic climates or the news or current events, because the professionals are doing the work for you. And all you have to do is hope that 1, Vanguard doesn't go bankrupt, and 2, you have cash to buy the dips when they come along. So picking individual stocks is a bit more dangerous. Picking ETFs is considered safer. And if I had to pick a number for what I would call a nicely diverse portfolio, I would say 10 to 20 stocks, maximum 20. And another section that should make up a part of your portfolio is bonds. A gilt is just another name for a bond. And a bond is essentially a loan of money. So if you buy a corporate bond, you're lending a corporation money. If you buy a government bond, you're lending that government money. And when things are going well economically, Stocks and bonds tend to move in opposite directions because they're competing for capital. Now, I don't know enough about bonds to teach, so I'm not going to pretend to, but it is something for you to look into when you're doing your own research. But one thing I do know for certain is that having a large enough cash position in your portfolio, or what they call dry powder, is what all the professionals do. Now, this here is my emergency fund, so I can't touch it, but if it wasn't, I could happily put €100 into a stock today if it was to drop 10% or 15% on bad news. But if I didn't have any cash position, I might be tempted to deposit money or sell something else to try and put it into this. It brings a bit more emotion into it, and emotion is the enemy of traders. It's more of an unfriendly acquaintance to investors, but that's the difference that having a long-term mindset will make. Ideally, I would say about 10 to 20% of your total portfolio's value should be in cash. So in this case, it would be about €1,600 to €2,000. Now, I'll make this section very quick because it is very simple. Whatever broker you decide to go with should depend on your investing strategy. Do you want to trade? Do you want to invest? Now, I don't trade myself, but I haven't heard good things about trading 212 as a trading platform. As an investing platform, I would absolutely recommend it. But one thing you should look for if you're starting from the very beginning is brokers that offer virtual or practice accounts. So it's just completely fake money. You know, it can give you a good taste of what would happen if you had actually put €1,000 into a company or 10,000 into a company. And it is great for practice because you'll see how a stock can drop on good news, a stock can go up on bad news. It's very unpredictable. And of course, depending on the time when you start investing, if we take 2021 as an example, everybody thought they were a genius. You could have bought lots of things and they would have went up. And now people are getting caught with their pants down. So you can open up a virtual account to practice, get the hang of it. And then the only thing you really have to consider is the country that you're in, the currency that you're using, the fees of the broker, and whether or not it's suited for what you want to do. Do you want to trade? Do you want to invest? Or do you want to do a little bit of both? I will point out that trading 212 pays interest on uninvested cash. It also pays interest on your shares being lent out for people who want to short a stock. And for me, it's been so far so good. Now, I'll keep this section quite simple and just give you the bare bones of what you need to get started and make a decision. So the first place to start is with a company or an industry that you understand and you enjoy. Now, what I mean here is there's no point in investing into a biotech stock if you don't understand it at all, and researching it would be an absolute chore for you. Now, you don't have to love it by any means, but if you hate biochemistry, then investing into a pharmaceutical stock might not be for you. The second most important thing is the company itself. We take this one, for example, Unilever. This is a very popular dividend stock, and you might hear a lot of people talking about it and say it is a good investment and you might go along with that, but when you do a little bit of digging, you'll learn that all of these brands are owned by Unilever. So they have what's called a moat of products. They have lots of different places that their income can come from. And then to give a general scale of the company, it has 127,000 employees, so it's a large company. It has a market cap of £95 billion, and that's how much the company is worth as decided by the stock market because it's publicly traded. And its revenue is £52.5 billion, and that's what's called the top line. That is the total amount of money that comes through the business, not profit. And another good way of getting a general sense of what a company is all about is seeing the segments that it operates through and the countries that it sells its products in. Now, Unilever is a very large company and it is worldwide. Now, we can see here it has subsidiaries in Argentina, Australia, Canada, Bangladesh, and the company is divided into 5 segments. And now, this is not strictly speaking, but when a company is very large, has a lot of money coming through it, and times start to get tough, they can say, right, we're going to cut 10% of our employees, which they could probably get away with. It's what I call wiggle room. It does mean that thousands of people will lose their jobs. That's what companies do to survive. A company like this can just up their prices, they can cut their staff, and they have their products spread out all over the world, and they have a large amount of products on offer. Then the next thing you can do to get a basic understanding of the company is find its full history, because the history can vary depending on the broker that you're using. Now, if a company is brand new, they're probably going to be focused on growth and they may not be paying dividends. But Unilever was founded in 1929, so it's what you would call a mature company. It would also be in your benefit to check the news, have a look at what the analyst sentiment of the company is at the moment, and you can dig into the history of the company a little bit, looking for things like stock splits, which is when a company increases the amount of shares that are out there. This is generally seen as a good thing because it makes room for new investors. There is also share buybacks, which is when a company uses its own money to reduce the amount of shares that are out there, thus increasing demand, so the price goes up. and also reverse stock splits or stock consolidations, which are generally seen as a bad thing. This is when a company decreases the amount of stocks that are out there by turning every 2 or every 5 or every 10 into 1. Then you'd want to check how the company is currently doing financially, and a couple of basic tools you can use in the beginning are the PE ratio, which is the price to earnings ratio, the EPS, which is the earnings per share. The PE ratio on its own is not really much use, to be honest, so what you want to do is compare it to the industry average of the particular company, or compare it to its peers, which are similar companies in the same industry. If it's below average, it means the company is undervalued and could be at a good price. And if it's overvalued, it means that the company is probably not at a good price. You'd also want to have a look at their current profit margin. You want this to be as high as possible. And their current debt to assets ratio. You want this to be as low as possible. That's their total assets, which are things that make money for the company, minus their total liabilities, which are things that cost the company money. And then onto the juicy part, which is the dividend. Now, when a company pays a dividend, the total amount of dividends paid will be taken from the stock price. This will happen on what's called the ex-dividend date. And this is the deadline before which you have to have owned the stock of the company if you want to receive the next dividend. If you buy it on the day or after, you won't get the next dividend payment. So if they pay $1 billion in dividends on a certain day, the value of the company will drop by $1 billion. So it's not free money. This is why you want to go for mature companies that have good profits, low debt, and they're sustainable so they can continue to pay and hopefully raise the dividend. Now, the dividend yield is not really much use, to be honest. As I showed earlier on with Armour Residential REIT, what you want to look for is how often the company pays dividends, how much the company pays out per share, the dividend payout ratio, which is how much of the company's profits are paid out as a dividend. If this is below 50%, it's considered stable. See if the company has been paying increased dividends year by year, which is always good. Because, for example, if you bought Unilever stock on the 3rd of April of 2009, you bought 100 shares and it paid 50 pence per share. If the dividend goes up over time, you will receive more money per share that you own, and this will increase your yield on cost. That's another important thing to remember in the beginning. You may buy a company that yields 5% at the moment, but if you hold on to it for 20 years and they've doubled the dividend since then, you've received twice the amount of dividends than you were back then. And see if the company pays any bonus or special dividends. Now, if you buy a fraction of a share of a company, you will receive the same fraction of the dividend. 0.1 of a share will pay you 0.1 of the dividend, so you don't have to wait until you can afford a full share. It is also important to understand your taxes for your country. There is different types of dividends, and depending on the country you're in, they could be taxed differently. On Trading 212, for example, you can see this information here. They might pay ordinary cash dividends, they might pay a dividend in the form of additional stock of the company, or it could be a return of capital, which is a tax-free return of some of the money that you put in, so you don't put it in with your regular dividends when declaring your income. They are few and far between. Now, there is plenty of other more advanced ways of valuing a stock, but this video is long enough as it is, to be honest. So once I understand them all enough to explain them simply, I'll put them into a later video. So that's all for this one, and fair play to you if you watched it all the way through, and most importantly, good luck out there.
Yeah, so keep the phones happy, keeps the doors locked, and keep the windows shut at all times. Thank you. Good night.
Good night.